Hey folks, Jeff here. Trying something new. My phone has a video camera built in, and it has access to upload it straight to YouTube. So hopefully we can accomplish this. Actually, this is the third one of these I've tried so far and have not got it to work yet. The first one I did was too long and it wouldn't upload to YouTube. So I'll be hopefully quicker on the draw this time to terminate the video in time so we can get it uploaded. The purpose being, I send you the video, the discussion of the topic I have at hand here, and you can view it at your leisure, or watch it again to make things you're clear on what I'm trying to say to you. Sheila's better. First point thought I'd mention, and hopefully I'm a little bit better. I was sick as a dog this weekend. And I was talking to Sheila, actually, this is Monday the 18th, and I was speaking to Sheila this morning and mentioned that I was having a hard time, I was feeling bad, had a hard time sleeping over the weekend. Barbara has some prescription sleeping pills, and she gave me one of them, and I felt like I'd probably taken a horse tranquilizer. I was just a zombie. So I don't feel 100% today, but at least good enough. Hopefully, I can be coherent in this discussion. And the point of this discussion is to bring out the points that are affecting Forex with the enactment of the Wall Street Reform Act, known as the Dodd-Frank bill. Chris Dodd, Barney Frank, and the Wall Street Reform bill that. I don't know if the entire bill takes effect today, but the Forex part of it takes effect today, and it is influenced where we do business and how we do business. A little background. The regulators have been trying to screw around Forex and trying to bring it under control, similar to the commodities market and the futures market for the last few years. And they came out with a set of regulations in August of 2009 called the FIFO rules, FIFO, first in, first out, which basically was regulating how the brokers handle order flow, but it also, touched on some other issues in Forex in terms of how we use leverage a little bit, but hedging and things of that nature. It wasn't a big issue. I considered it a little bit of a nuisance, but didn't really feel at that time it was, that big of a problem. Then in December of 2009, they came out with a new set of rules. It started tightening the screws a little further, started messing with leverage, etc. So I did what a lot of people did, moved my account overseas. I went to the UK, tried a firm there for about 3 months, and they just had too many problems, actually too many chart errors. If you're trading on the charts, and you need to know what's going on the whole every second you have a trade open and the chart has problems, you can't live with that for long. And so we went to a firm in Australia, being Go Markets, that actually I've been very satisfied with. They have good spreads, cost of transaction, their executions are good, didn't have chart errors, those kind of things. But anyway, and up until Friday, October the 8th, I guess it would be, Go Markets was maintaining a position that the new U.S. regulations was not going to affect them. That they weren't governed by the U.S. regulations. It didn't have to really pay them much mind. Well, I received an email on that Friday the 8th, that said that due to some interagency cooperation type agreements that they are going to be regulated or have to adhere to the U.S. regulations, and bottom line was they could no longer do business with U.S. clients, which I'm sure they didn't like that idea. They just had gone through a period where they were expanding kind of their infrastructure and putting servers, etc., in the U.S. so there was better connection speed and just reliability in the system, the whole 9 yards. So I'm sure that's all for naught at this point. But what has transpired is that the new bill, the Wall Street bill with the Forex provisions in it, the main thing it does, aside from several issues, but the main thing that's most noticeable is it deals with leverage, how much money you have to put down in order to enter a trade. Prior to August of 2009, the standard somewhat in the U.S. was 400 to 1. You might get a little bit more better than that. Some firms might be less than that, but there's a lot of firms out there that offered 400 to 1 leverage. So what that means is you took the value of the contract and divided it by 400, and that's how much money you needed to enter the contract. So $100,000 contract divided by 400 that gives you what, $250. So that was kind of the standard in the industry to a certain degree. After the new regulations that took place at the end of '09, a lot of people moved their accounts overseas just to avoid that specific issue. But that can't be the only issue in terms of determining a broker. There's lots of other things involved. Like I mentioned a minute ago, chart error is obviously a big one, and the stability of the country and the broker, and et cetera. So I was very satisfied with Go Markets, but as of the 8th, Go Markets' position was they do have to follow with the U.S. regulations, and as of today, Monday the 18th of October, they can't execute trades for U.S. customers. So I had looked around a good bit when I knew this was. I spent last week basically looking around a good bit to see what our options were and where I needed to be. So I have landed on a company called Dukas Copy, and I'll send you their link in an email. That's based out of Switzerland. Now, it's not the choice of Switzerland is not based on the fact that we're there because of Swiss bank laws, that they're more private or secret or whatever. They may or may not be. They're not as good as they used to be. They're probably better than a lot of places, but it's strictly based on the issues from a broker standpoint that I look at. And those issues they used to be include leverage. Leverage is not much of an issue anymore because you're pretty much hands are tied on what we can do there. Actually, Dukas Copy is going to offer 100 to 1 leverage as opposed to 50 to 1 leverage, so they're better than the U.S. regulations. But still, it takes 5 times as much money to enter a trade with Dukas Copy than it did with Go Markets. Being at Go Markets, we had 500 to 1 leverage. At Dukas Copy, it's 100 to 1, which is affects somewhat the way we do business. But the other factors are really more important than the leverage. They are, the stability, as I mentioned ago, the stability of the country and the company. You don't want to be in some third world country with your money there trading with a company that's, obviously in a third world country. Then who knows the stability of their banking system, of their, legal system, their government in general. Switzerland, meets that criteria. Secondly, we want to be with a firm that does not have a dealing desk. And what I mean by that, we want to deal with a firm that they are not trading against us. Whenever, for instance, a dealing desk firm, if I'm buying, they're selling. If I'm selling, they're buying. They're taking the other side of the trade, which means they make money when you lose. Well, I don't think it's prudent to be with a firm that knows how much money you have in your account, knows your stop losses, your take profits that you enter into their system, and they're making money when you lose money. It's like, I hate to use the similar situation of Las Vegas. Don't consider we do gambling, but just like Las Vegas, they're happy to have you there as long as you are losing. You get to be good at trading. They start screwing around with you and don't want you to hang around so long because they're losing money. They're not making as much money on their fees as they're losing in terms of their trading against you. So I'm very specific about wanting firms that do not have a dealing desk, so that I'm not dealing with a broker who is trading against me. And the other things are, like I mentioned before, the reliability of the charts. We don't want chart errors. The execution speed. When we push the button to say, give me this order, we want to know we get a fill. If you get a bad fill, it's called getting filled away being away from the price that we wanted. We don't care for that. So execution speed, the cost of the transaction, the spread, what does it cost to do business with them? The country and the firm, whether they have a dealing desk or not, et cetera. All those are all factors that go into the decision-making process of where we're doing business. So my video time is about to run out here. I have a 10-minute limit, so I'm going to wind this up real quickly. I will be sending you documentation that you have to, amendment to our agreement that asks you to sign off, with the understanding that we have moved the account to Switzerland, to Dukas Copy, and if you have any questions or any of that, I'll be glad to discuss it with you at length, but I want to at least give you a background on what we're doing and why we're doing it. Thanks very much. Talk to you soon.